You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank global banking and markets leaders designed to provide you with timely insights and analysis. China appears to be at the beginning of a recovery, while the world's largest economy, the United States, is still reeling from the effects of COVID-19. Emerging market economies around the globe rely heavily on the health of these two giants for trade and investment. But which countries are exposed to greater risk due to additional domestic weakness? And which nations could recover ahead of us all? On this episode of Market Points, Scotiabank Associate Director and FX trader Bertha Arroyo shares an update on the opportunities and threats facing the emerging market economies in Asia and Latin America. Hi, Bertha. Thanks for joining us on the podcast today.
Hi, Greg. Nice hearing from you.
Bertha, when you're thinking about how emerging market economies have specific struggles in the COVID-19 pandemic, what are some of the key differences between their challenges and, let's say, the challenges that we face here in Canada?
Yeah, that's a very interesting question. So, in the case of developed countries such as Canada or the US, you have countries with strong governance capacity. You have very well equipped healthcare systems, and then you also have the possibility of issuing reserve currencies such as the Fed or ECB or BOJ. So, in the case of developing markets or emerging market economies, they're currently facing a multi-layered crisis. First of all, they are facing a health shock as they definitely have a way more limited health system capacity compared to developed countries. Then also they're facing the domestic economic disruptions related to COVID lockdowns. Additionally, they're facing external demand shocks. Most of these emerging market economies are commodity exporters, and there's been a collapse in commodity prices. And finally, I think which is more important is borrowing constraints.
So emerging markets have these special circumstances that they have to consider that make this situation more dangerous for them. At the same time, from a reporting perspective, at least, the numbers we're seeing, the United States has suffered the greatest across the globe. Which emerging market is most connected to that? Which country is in the riskiest position because of their connection to the United States?
Mexico. Mexico has a high degree of dependence to the US, as close to one third of the GDP depends on exports to the US, and that's not including money coming from remittances or tourism from the US. So definitely, Mexico right now is one of the most vulnerable emerging market economies, and that's been shown in the way the Mexican peso has performed. So dollar mex right now is one of the worst performing currencies year to date. Is down 25 almost 25% on the year to date. Now, on the positive note, Mexico remains one of the highest yielding currencies in LATAM, and as yields around the globe continue to contract, Mexico still has an appeal for investors as a carry trade. Once obviously volatility eases, right? Carry trade happens when there's no volatility. So as long as volatility persists in the pair, we're not gonna see yet these carry trade investors.
Was Mexico already in a recessionary period entering 2020?
Yeah, yes. So Mexico already started with vulnerable conditions as they come from years of disappointing growth, and they were officially declaring recession last year after they had a flat GDP in 2019, and investors were already spooked by AMLO nationalistic measures as well.
So, what kind of action are they taking from a fiscal stimulus perspective, and how does that compare with, for instance, other countries in Latin America?
Well, you have Brazil having a 10% of GDP fiscal package. You have Peru with a 12% GDP fiscal package. Mexico has only announced a package worth 0.7% of their GDP. So, despite the fact that they're like one of the most severely hit economies, they're the one that has announced the smallest fiscal package.
Well, China's coming back now. Will that start to help out some of the other emerging markets?
We've seen, I mean, China is a big driver for all emerging markets. So whatever happens in China really impacts most of the other commodity exporters. So interesting enough, countries such as Brazil, Peru, Chile, one of their biggest export partners is China. So they're more impacted about what China does than what the US does.
And so, what about China's emerging market peers in Asia? Is Are there circumstances tied to China like LATAM?
EM Asia, it's a very different story to LATAM. It's the only emerging market group that is expected to have a positive GDP growth in 2020. This is a statistic from IMF. They're expecting it to grow 1%, with both China and India being the main growth drivers of the group. Now, why is this different from LATAM, right? I think because Asian currencies have better fundamentals based on current account, exposure to oil, and fiscal balances versus other EM, like I was mentioning earlier, LATAM.
South Korea is in the news cycle, always cited as a strong example of a country handling this crisis and starting to come out of it. Uh, what about other Asian economies like Taiwan?
Yeah, so both South Korea and Taiwan, they both have emerged as a gold standard in terms of coronavirus, as they both have done such a good job containing the outbreak, better than most of its peers, without having to impose drastic mobility restrictions or national lockdowns. So definitely, in this sense, both countries should avoid partially the demand shock that we've seen in other economies. Nevertheless, as the rest of Asia, both countries are not immune to a global slowdown, as lockdowns within key trading partners such as Europe or North America will definitely take a toll in their economies. Now, stimulus packages should have help ease some of the negative effect of the global economic slowdown. So both countries have implemented stimulus packages, measures that account to about 5% of GDP. Now, in the case of Taiwan, we expect our Taiwan to remain trading around 30 in the 1 month NDF, but definitely we expect it to continue to outperform its peers, such as China or Korea. Now, overall exports year over year down 0.6%, still better than what market expected, as we're starting to see that the trade with Japan, US, and Europe has started to slow down. Nevertheless, the trade with China has remained well supported, which is interesting to see.
So, what is the composition of that trade with China?
So, for instance, Taiwan's tech sector has continued to outperform even during the crisis. With tech exports, they're up around 18% year over year in March, especially the exports of electronics and information and communication technology products, which represent a big part of their total exports, almost about 40% of their total exports. Nevertheless, we've seen a slowdown in the non tech exports, which makes sense as we have like depressed oil prices and weak external demand across chemicals, metals, and machinery products.
So, what's the net effect on exports here? Is it ultimately still being pulled down because of the global slowdown?
The last data, which was export orders in March, was up actually 4.3% year over year, which is the biggest gain in 17 months. And now that's why most analysts are saying that Taiwan right now it's a diamond within emerging markets, as we have not seen yet a slowdown based on all the economic data that has come out. This increase in export orders is explained partly because China has resumed production after being shut down January and February, and also because importers around the world have started to look to diversify supply chain risk away from China, and Taiwan has been one of the most favored countries for that.
Has there been any uptick related to businesses having to sort of quickly react and invest in technologies that allow a bunch of workers to work from home across the globe? Has that kind of
Yes,
impact been felt in
yes.
exports already?
Exactly. And I was reading about that. So one of the reasons we're seeing a strong Taiwan tech sector is because most people have started to work from home and that require more computer products. So that actually helped Taiwan.
And what about South Korea when you're thinking about trades?
So South Korea is also one of the good examples in terms of EM. So we had the victory of the South Korea Democratic Party in April 15, and this has eased political uncertainty and makes it easier to approve further fiscal stimulus package. So that's very good for Korea. Now, nevertheless, we started to see. So I was mentioning before that we have not seen yet a slowdown in exports from Taiwan. Nevertheless, in South Korea, we started to see a hit from this economic slowdown. So exports in April reported were down 27%, which is the lowest level they've been since 2009 in the first 20 days of April. As the trading with its biggest trading partner, China, dropped 17%. Nevertheless, Korea is also an oil producer, so they've been impacted negatively because of that. But overall, we're because of how good they managed the outbreak, how they haven't had the demand shock, and also how active the government has been to implement a stimulus package. I'm still pretty much optimistic, Korea, and I think for now, I like being a seller of dark Korea in the 1 month NDF around 1230, 1250 area, targeting a retrace back to 1210 or even 1190 once all these COVID-19 pandemic eases.
So Korea and Taiwan are starting to benefit from China reopening. But as I understand it, there's still some nerves around the fact that they haven't released a large stimulus package. Why is that?
Because in 2008, 2009, they did pull the trigger, and they definitely went big on the fiscal policy side, therefore avoiding economic construction in the region and to other commodity exporters. But this time they've been very, very shy. So right now, the fiscal policy package that they implemented, it only adds up to 3% of their GDP, which versus its peers like US, Japan, it's very small package. And they mostly had target measures to help sectors that have been the mostly impacted by COVID-19. But as of now, I think what they say is that they want to focus in sectors that have been affected, trying to ensure that the payments that the payment system is not affected. They're trying to provide liquidity in the market. They announced a bunch of liquidity mentions. They cut rates to help small and medium companies, but that's been about it for them.
So they have some programs in place. What are you seeing so far in the data with respect to the Chinese economy? And what does positive numbers, or at least the tracking of positive numbers in China, mean for the rest of the world?
Now, in China, most of the COVID shock is concentrated in the first quarter, and we have already seen a recovery on the data in March versus January and February. Last week we had the GDP first quarter release, and this showed that the recovery was faster in the supply side than in the demand side. So in the demand side, we're seeing a big contraction in investments and retail sales versus industrial production. We've seen that most companies have already resumed production. So what this says is basically that it's easier to open back factories than to make people spend. And people are not really willing to spend until this COVID-19 situation eases. So that's gonna, like, this data in China is gonna let you know what's gonna happen all across the globe, right? So this is like a window to the future.
That was Bertha Arroyo, Associate Director and FX Trader at Scotiabank. You can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.